Ladies and gentlemen, good day and welcome to the Q2 FY23 earnings conference call of 3i Infotech Limited. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Asha Gupta from EY Investor Relations. Thank you, and over to you, ma'am.
Thank you, Steven. Good afternoon to all of you. Welcome to the Q2 FY23 earnings call of 3i Infotech. The results and investor presentation have been already mailed to you, and you can also view it on our website at www.3iinfotech.com. To take us through the results today and to answer your questions, we have the top management of 3i Infotech represented by Mr. Thompson P. Nanam, Managing Director and Global CEO, Mr. Harish Shenoy, Chief Performance and Risk Officer, Mr. Sanjay Rava, Chief Financial Officer, Mr. Mohan T.S., Chief Human Resource Officer, and Ms. Varika Rastogi, Company Secretary and Head Legal. Thompson will start the call with the business update, which will be then followed by Sanjay, who will update the financial performance, and Harish will provide the update on business excellence and delivery excellence. Mohan will update on people strategy, and then we will open the floor for Q&A session. I would like to remind you that anything that is said on this call that reflects any outlook for the future or which can be construed as forward-looking statement must be viewed in conjunction with the risks and uncertainties that we face. These risks and uncertainties are included but not limited to what we have mentioned in the prospectus filed with the Sept and subsequent annual reports that you can find it on our website. The presentation which we have uploaded, the safe harbor, just I would read that out. The presentation has been prepared by 3i Infotech solely for information purposes without any regard to any specific objectives, financial situation, or informational needs of any particular person. This presentation may not be copied, distributed, or designated directly or indirectly in any manner. Failure to comply with this directive may result in the violation of applicable law in certain jurisdictions. By reviewing this presentation, you agree to the bound by the restrictions contained herein to maintain absolute confidentiality regarding the information disclosed in this material. This presentation does not constitute or form part of and should be construed as directly or indirectly any offer or invitation or inducement to sell or issue or any solicitation of any offer to purchase or subscribe for any securities of the company by any person in any jurisdiction, including in India, nor shall it be any part of it or the fact of its distribution from the basis of relied or in connection with any investment decision or any contract or commitment thereto. This presentation contains the statement that constitutes forward-looking statements. This statement includes descriptions regarding the intent, belief, or current expectations of the company or directors and officers with respect to the results of operations and financial condition of the company. This statement can be recognized by the use of words such as expect, plan, will, estimate, project, or other words of similar meaning. Such forward-looking statements are not guarantees of future performance and involve risks and uncertainties, and actual results may differ materially from those in such forward-looking statements as a result of various factors and assumptions which the company believes to be reasonable in light of the operating experience in recent years. The risks and uncertainties relating to this statement include but not limited to the risk and uncertainties regarding fluctuations in earnings, our ability to manage growth, competition, our ability to manage our international operations, government policies, regulations, etc. The company does not undertake any obligation to revise or update Any forward-looking statement that may be made from time to time by or on behalf of the company, including to reflect actual results, changes in the updates, any forward-looking statement that may be made from time to time by or on behalf of the company, including to reflect actual results, changes in the assumptions, or changes in factors affecting this statement. Given this risk, uncertainties, and factors, viewers of this presentation are cautioned not to place undue reliance on this forward-looking statement. This presentation may contain certain currency exchange rates and same have to be provided only for the convenience of the readers. With this, I will now hand over the call to Mr. Thompson. Over to you, sir.
Thank you, Asha. Good afternoon, good evening to everyone. Hope you and your families are staying safe. My season's greeting to each one of you. I'm happy to share with all of you that your new 3i, which is 6 quarters old, post the carve-out of the product division, is making strong positive strides in spite of strong headwinds with global changing macroeconomic situations, geopolitical environment. The new 3i with rich 27 years legacy of being born out of a bank, reinvented and rebooted as a new organization with entrepreneurship in our heart, as we set out to build a new 3i with our new identity to innovate, incubate, and invent, and become a strong challenger in the IT services business as a one-stop orchestrator, business problem solver company aligned to the outcomes of our clients. We are focused in becoming a leader in edge computing by our cloud-first, digital insight, cognitive-powered, edge-ready strategy. It's a unique challenge and opportunity for the management team of your company to run efficiently the enterprise business and in parallel grow rapidly the digital and the next generation business and build new products and platforms with IP which will create huge value for your organization. We set an ambitious goal to achieve 760 crores top line and a growth year on year from our last year's revenue of 675 crores with a PBT of 15 crores. And we also set ourselves a goal to change the revenue mix from our classic enterprise business to more profitable digital and next generation business. I'm happy to report the following results of your company for the quarter, the first half of the financial year. H1 FY23 revenues, we clocked rupees 358 crores. Quarter 2 revenues of 178.3 crores. The gross margin of 10.5% leading to 37.4 crores. And a PBT of 15.75 crores. And a PAT of 17.11 crores. And our CFO, Sanjay Rao, will expand the other currency-related gains which enabled our positive PBT. H1 operating EBITDA, though negative, minus 23.24 crores. This is the task in hand for your team to ensure that we break even and create a sustainable, predictable, scalable business. The revenue exchange which our grow and build initiatives are starting to bear fruit. Classic enterprise business generated 281.3 crores with a GM of 77.4% as an organization, and we focus on running this more efficiently and get the gross margin up to 10%. In the same period, in the H1, new digital and the next generation business is growing steadily, and we're happy to report that we delivered 75 crores in H1 with a gross margin of 22.1%. This is the focus area for us, and this is very important for us to change the revenue mix from our classic business to this next generation digital and next gen business. The digital and next gen business has a good funnel of 180 crores and a potential order book of almost 55 to 60 crores in the H2. We have onboarded almost 29 new logos, new clients in H1, and have a huge potential for us to build an order book of 100 crores based on our land and expand strategy in these new logos. The enterprise business is on a roll with the recent win of infrastructure management services division with a large 3-year TCV of 50 crores in H2, the start of October, and we're happy to report that as part of the earnings call, which is a large PS in India. And the details of this we will probably come with a press release shortly. The India standalone business is also on a course to deliver the 260 crores target, which is also a steep target it took on a year-on-year growth of 20% over last year's performance. and with a very strong funnel and order book. I'll now quickly update you on the progress of the various build initiatives your company is investing, and this is very critical for us to build the new products and platforms which will make us the real edge-ready company. Neuray 3i Plus, which is a sovereign cloud, has been launched in Malaysia, and Neuray Velocity Services will be commercial grade by November end in this cloud, and this is going to be the first business process as a service offered in our own Neuray cloud, which is again an Oracle-powered initiative. This is one of the kind, partnering with Oracle and Government of Malaysia and 3i in creating this very, very unique go-to-market where we want to help digitize the SMBs in the Malaysian territory. Our IIT Tech Park Edge Computing COE is live, and they are working hard to launch the 5G Lab as a service. It's again one of our very unique propositions we want to take into market. We are also working on our own private network solutions and SD-WAN solutions as well, which is also going to be a very important value proposition in our arsenal. Neuray Edge product, Neuray Edge, which is our SAP product, which is already commercial grade and is starting to generate revenues. Our Oracle COE, which we launched in January, is graduating our first batch of engineers being certified by Oracle University across cloud, application, analytics, and automation. All these, positive investments we have made in all the past quarters are starting to bear fruit, and we hope to see a better result in the coming quarters and systematically change the revenue mix and build a more sustainable, profitable, and scalable business model. Thank you. I will now hand it over to Sanjay Rao, our CFO, to expand on the financial updates. Sanjay.
Thanks, Thomas. Good afternoon, everyone. I'd like to provide key highlights for the financials for the quarter ended 30th September 2022. Our revenue remains near the flat for the quarter at rupees 177.1 crores in comparison to the last sequential quarter, revenue of 179.2 crores. We had a project closure in Middle East on account of a low margin and a loss-making engagement, which has resulted in drop of revenue of 2.5 crores in revenue, which we have closed down that engagement. Coming to the employee expenses have gone up by 6 crores for the quarter in comparison to Q1. This was primarily due to the increments that we had given the increment period being in the second quarter, and the variable fee, a one-time variable fee of 5.4 crores. Cost of third-party products and services has increased by 6 crores due to billable subcon cost increase in the US, which is primarily I would say replacing our existing employee cost, which had seen a drop in the last quarter. Our other expenses for the quarter stands at 22.7 crores, which is lower in comparison to the sequential quarter by 1.5 crores. As a result of an ongoing cost rationalization exercise, which we are on to. For the quarter, the reduction has been in legal and professional fees by 1.4 crores and repairs and maintenance by 0.7 crores, which is offset to a certain extent by increase in our travel expenses, primarily sales-led by about 0.6 crores. Coming to the other income part, in the forex gain for the quarter, continuing with our Q1 exercise wherein our US operations have become non-integral. During the quarter, our other territories, Middle East and APAC, have also become non-integral operations with India, due to which the currency impact is now considered in the other comprehensive income, resulting in an overall net gain of 48.7 crores for the quarter. Tax expense, we had a one-time tax refund in our BPO subsidiary amounting to 60 lakhs and a reversal of certain tax provisions in the US, which has resulted in a credit for the quarter and for the H1 period ended 30th September 2022. Coming to the balance sheet, let me give you some key highlights of the balance sheet. Our fixed assets for the half year ended 30th September 22 has moved up by about 8 crores due to addition of the existing build-related project capital work in progress amounting to 14.5 crores. And we have also added some tangible assets for procurement of laptops for our ongoing, new additions to the headcount. So overall, that has come to a net increase of 7.7 crores. Trade receivables has moved up by 6.5 crores. Our bill DSO stands at 52 days, which is more or less in line with our March 22 period. Receivables from certain government customers were delayed due to sign-offs which were expected, but those got delayed. But we expect DSO to move below the 50 days level by Q3 end. Cash balance is at 55 crore overall. The net decrease of 81 crore. We have already given the cash flow statement as part of our semi-result data. But I just want to give some key highlights of the cash flow. Our cash from operations has come down by 18 crores. Taxes paid, which were primarily TDS additions, was for about 6 crores. Capital work in progress, which is part of the build project that we had, has an addition of 14 crores. And we had certain, short-term borrowings in terms of working capital and the lease liability going down the 43 crores. So this has been the movement in the cash balance from the March period to the September end period. So this is the overall, I would like to give a synopsis of the financials. I'll be happy to take questions as we move along. Before I give the mic to my colleague, Harish Shenoy, for his updates.
Thank you, Sanjay. Good afternoon, everyone, and season's greeting to all on the call. To give a quick overview of our operations, we started building capabilities over the last 12 months, which has reached a certain level of maturity, and we can comfortably say that they are market grade today. To name a few, in H1, infrastructure management support has reached banking grade and started operations for Dhanlaxmi Bank, and also acquired new logos in other industries like retail, namely Vishal Megamart. Our cognitive computing services are working on credit union opportunities in the US. Our KPAS, BPAS team have been pursuing global opportunities in UK and Africa. We have acquired new business with IDFC Piramal Group, to name a few in H1. Continuing with our operations in the enterprise business unit, we are working on improving the efficiency and have identified specific levers to improve GM by 2% in the named few BUs, and this will help us to get a minimum GM of 10% across the enterprise business unit. That's what we are targeting to at least end this financial year with. We are systematically and strategically getting out of low margin or negative margin contracts, as Sanjay mentioned in his talk, globally, which has impacted our revenues in Q2. But that's going to finally improve the health of our organization as a result of all these actions. So in spite of the annual increments to our employees, we have been able to maintain a flat cost base. Again, I can touch base on this. So the whole intent is to make the organization more leaner, and we'll be focusing also on our sales and general admin costs that we are incurring for the entire organization. So this is on the enterprise business operations. Quickly moving on to standards and certifications for the organization. We've got recertified on various ISO certifications applicable to our lines of business. On CMMI certification, we are at level 3 currently and working on achieving level 5 in the next financial year. We are ensuring that any new projects that we are starting should be with the benchmarks that we would want to achieve. So we don't need to do a catch-up, at least for the new projects. It's only the old projects which we need to grade them up to level 5. We have initiated actions on making our offerings GDPR compliant as we increase our global reach. And we are starting off with specific geographies now and not all over. So that's a focused approach on the GDPR compliance. We are also looking to be ESG compliant and have started defining a roadmap for the same. Quickly to move on to risk or GRC for the organization, though we are 6 quarters in this new 3I, we are still dealing with legacy issues that needs to be resolved. Learning from our experience to ensure we do not repeat history, we have embarked on an organization-wide risk assessment methodology for any new transaction that gets done. And we are also assessing the historical transactions which are currently live so that we try to document and have mitigation plans for that. Just to give a sense of importance that we as an organization are giving to this activity, it has been driven and monitored by our board with appropriate guidance from our directors. This will finally enable us to score various risks and various categories so that we are better prepared with proactive actions to mitigate the same. This is like the various initiatives across the organizations that we have started and will be working on in H2. So the intent is to move towards a more efficient, more leaner organization by end of this financial year. With this, I would like to hand over to P.S. Mohan, our new CHRO, share our people strategy. Over to you, Mohan.
Thanks, Harish. Hi, everyone. Good evening and season's greetings to all of us. Very glad to be part of this family, 3A family. Thank you so much, everyone at the leadership team. Quickly to summarize people strategy is very clearly called out and put in practice towards performance-driven culture. It is a culture-embedded strategy where each of the leader to the last mile of an employee is aligned to clear-cut performance targets. Thereby, a balanced scorecard approach has been adopted and institutionalized in the organization so that a last mile employee can also see what's the outcome in the company by his or her contribution. So that culture we're driving very rigorously, due to which we also revised our approach towards reward and performance actions very stringent in relation to the achievement. Thereby, all of us as a one family continue to align to our outcomes, business outcomes. Yeah, that being the strategy, we have seen 8% growth in our headcount in the H1, which is part of it is also related to the Q3 business growth, which we expected to bring on board, like Thompson shared earlier. And for the H1, we saw a 19% voluntary attrition annualized, which is 2 percentage points lower than the H1 of the last year. This also reaffirms our belief that when we have a positive performance culture driven in the organization, employees continues to show their confidence and trust in the organization significantly and continue to contribute. So this is the quick environment we're building in the organization across the layers, across geographies. Due to the performance-driven culture, we also see some of the actions being taken for non-performance, or also supporting environment to allow employees to perform better. So all those instruments are being built and are being institutionalized. Thank you so much.
Can we open the floor for Q&A?
Yes, please.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Siddharth Gupta from Voyager Capital. Please go ahead.
Good afternoon, everyone. I must again start by saying that as an investor, these aren't exactly great results to begin with. I have a few questions to start off with. First of all, this is a narrative which we've been pursuing for a few quarters now, that we've been moving from low margin businesses to high margin businesses. And I can see why that would keep the revenue intact and grow at a lesser rate as compared to our peers. But operationally also our margins haven't been rising, and in fact we've been consistently reporting negative operating EBITDA. So could you elaborate as to why this phenomena is happening and why isn't any change coming in on this bit? The second bit that I wanted to ask was about how much exactly hard cash do we have on our hand? Because from what I understand, in the next couple of quarters, we would be running out of cash again. So is there a fundraising plan in place? Is there some, not cash equivalent, but hard cash that we have on hand? The third bit is with regard to some net payables mentioned in note 7 of the standalone results pertaining to our foreign subsidiaries and some FEMA regulations. If the management could elaborate on that, that'd be great. Thank you.
So thanks, Siddharth. Great question. So I'll try and answer there are three questions in this. The first question is, you're talking about the revenue mix change we are now trying to strive and change. And second, you spoke about the pace at which the margins will go up. So I'll just expand on what I spoke earlier as well. There are two parts to it. One is, I think we need to recognize the fact that the current business which we inherited is something where we need to kind of try and see how we want to drive more efficiency, and which the team, in fact, Harish spoke about it, which we are having very clear-cut plans to optimize costs in the classic enterprise businesses, which we see at least an upside of around 2 to 3% GM for sure in our plan for H2. That's point number one. The second question which you spoke about is the revenue mix change of the new lines of businesses. If I look at it, most of them from a concept to an idea to a concept to reality, if you ask me, most of them are 2 quarters old, if you ask me, because from an intent to where we are right now. And slowly we are seeing that, as I said, some of the numbers I shared, as we are starting to track this digital and next generation business, the details are available in our presentation as well. We have clocked almost close to 75 crores this H1, which we classify in this higher margin business. And relatively, we are now making almost close to 22% GM. And this is after the lot of setup costs and also startup costs which are there with us. So on a normal BAU, if you see some of these businesses as they ramp up, will start hitting upwards of 25 to 26% gross margin. That is one. The third thing is also from a lot of the old classic business which we inherited also. We are now very, very critically looking at businesses which are, bleeding us, and we are also proactively eliminating them. That is also, for example, as part of the cleanup, we eliminated some businesses which also hit our top line this quarter, but we took that call because it's a permanent fix on the continuous bleed with these businesses must have on our P&L. So these are some actions we are taking in terms of margin maximization and also on the revenue mix change. Right? On the first question. Then I think you asked the second question in terms of the cash in hand, right? If you look at it from a cash perspective, of course, like what Sanjay spoke about, right now the cash is around 55 crores. And yes, definitely, because we are funding multiple projects. As you know, we have built projects. This is a very complex operation because in parallel we are building products which needs to be funded. We need to build competence and capability to stay relevant, and also keep running our current operations. So as I said, it's a very unique challenge which we all love to take and kind of turn around the organization. And to your specific point, at this point of time, I think if you ask me, the key point will be that we will take a call to raise more capital maybe in 1 or 2 quarters from now, because we are also seeing our closure of our carve-out deal, and we are also expecting to finalize those accounts, and then we will take a call in terms of decision to raise capital. The third question I think you spoke about on Yeah. You want to talk about that?
So these are, coming back to the disclosure and the 0.7 the notes in the standalone results. So these are, as a new management, what it, and these are some old balances that are receivable and payable in the standalone entity. And as part of our ongoing exercise in reporting to RBI, we have initiated for a set-off of these balances with RBI. In fact, this has already been kind of given to our authorized dealers of the bank. There are certain other documentation which the banks have required us to provide, which we are in the process of providing to them. That's kind of an update.
Yeah.
Right. So if just with regard to the last question, if I'm correct, it's just a technical accounting entry left and not actual payable balance that is coming onto our books, right?
No, these are actually old balances appearing since years together, more than 10 years old, I would say. In fact, the statutory auditors in their March accounts and in the March results, they have indicated this as part of a disclosure. But these balances are more than 10 years old, and the company is in the process, and the company already initiated the dialogue with the authorized dealer way back in the year, I would say in September 2020. We had forwarded a communication to the authorized dealer ICICI Bank to RBI with a request to set off these balances against the payables to the receivables. And thereafter, we have understood now that the authorized dealer has been asked to get the data from us, some additional information, which we are in the process of providing it to them and to RBI to get this resolved.
Right. Okay. And with regard to the first couple of questions, do we have a guidance from the management in terms of when we can expect at least operational break-even or some profits on the consolidated basis?
Yeah. So, Siddharth, as I said, if you look at it even this quarter also, when we drill deep, if you look at it, we had taken a view to, ensure and invest in our human capital. If you look at it, major costs, if you look at it, almost close to 10 crores, if you look at it, have gone for ensuring it goes back to the investment in human capital, because it's very, very important for us, if you look at it. Now, once you remove that, it's not very far away from where we are from our break-even perspective. So, if you ask me very clearly, Siddharth, we are on course to break-even, and that's our first milestone, as I've been telling consistently, without any surprises also, which keeps hitting us. But we will break even operationally by this Q4, which is what, as a management team, we want to kind of commit, irrespective of the PBT numbers which are there because of these exceptional gains. So what we want to endeavor is that, at least what we promised with 760 crores and 15 crores PBT, which we gave at the start of the year, with at least operating margin positive, and will be a great way to start the next year. That's the way we want to look at it, Siddharth.
Okay. Thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Vaibhav Barjatia from Honesty and Integrity Investment. Please go ahead.
Yeah. Hi, sir. Thanks for providing the opportunity. So just a small clarification. So in terms of foreign exchange gains or loss that is there, being now reported every quarter. So basically, the corresponding contra entry of loss related to this gain is sitting in foreign exchange current translation results in the balance sheet, right? Is my understanding correct, right, on the consolidated basis?
Yeah, you're right. I mean, if you see under the other comprehensive income, it's sitting there.
Okay. So the profit is okay. Understand. And going forward on every quarter based on the INR fluctuation vis-a-vis the reported currency fluctuation, these gains or losses will continue to get reported every quarter, right?
Yeah, but it won't be to this extent, because the one-time adoption happened now, post the way the operations are now conducted. Going forward, you would see, as the rupee depreciates, we would still see some gain coming, but it won't be to this extent.
Okay. And if rupee appreciates, then definitely there will be negative charges.
Reverse impact. Yes, you're right.
Okay. Got it. Understand. Yeah, that's it from my side. Thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and one. The next question is from the line of Purushottam Savlani, an individual investor. Please go ahead.
Hi, am I audible? This is Purushottam.
Yes, sir.
Yes, for sure.
Okay. I wanted to draw your attention, Thompson, to last year's Q2 performance, where we had an adverse hit of close to around 25 crore on account of proactive provisioning which was done for PDDs, and also performance bonus which twice. So that was roughly around 25 crore of excess provisioning which was done. And what we were told is at least those PDDs which have been accounted for, 50% of that will come back, if not all. Now, having said that, this year, since we are done with all those provisions, one was expecting that not only the performance will get added by the flowback of provisions, but at the same time, new hits will not come. If I add that to the foreign exchange gains which have come, profit should have been much more. So that doesn't reflect out here. At the same time, employee cost continues to be very high, which is in this quarter, say around 85%. What we were told in past is that we have hired manpower to ensure that we have right kind of representation, etc. So one is it is not reflecting in terms of the performance of sales growth. At the same time, cost continues to be high, and whatever has been provisioned in past doesn't reflect that advantage in this quarter. So somewhere the math is not adding up, asking clarity on that.
Yeah, so I'll try. Thanks, Purushottam. Great question. I'll try and answer that, and also probably ask Sanjay to step in. Two questions. If you spoke about last quarter, if you look at the provisioning which we had done also. See, post the carve out, we had done a full cleanup, as you rightly said, because we didn't want to we wanted to start it with a clean slate. We wanted to kind of proactively write off some of these, long outstanding which we had, and we did the proactive PDD cleanup. You're absolutely right, and in fact, it's spot on. And today, I think we are more healthier. If you look at it, we are very cleaner because our PSOs are better. Our ability to manage these is more better because of those actions. Now, secondly, also, if you ask me, the plowback of this proactive also, the teams have been working very hard. So we are proactively done to even get back some of these stuff. And I don't know, top of the mind, I can say at least 25-30% of that we have collected. And we continue to even say some of them, even pursue them legally as well. So that is one, just to reassure where we are up to. That is one. The second point you spoke about the performance bonus also, which was provisioned last year. Just to clarify, I'll tell you. Technically, and we are also trying to, fix that once for all, is that, we were always, historically also, what we inherited. We were under provision, and then we are trying to pay it in by cash in the current year. So fundamentally, what happened? You pay the previous year's performance bonus last year, and it takes a hit in that particular financial year. Now, what we are doing beyond this, as a clear, like what Mohan spoke, our new CHRO spoke about, we are going to be a clearly performance-driven organization, and at least from a mid to senior level, all of us, we will play it by performance, by cash. It's very, very clear. So we know no longer any provisioning will be happening. Every variable pay performance will be, we will decide on 30th of March. Very, very clear. I'm very open about it. And this is going to be the culture which you want to build as an organization. So even right now, because we are still in that old, catch-up mode where we had unprovisioned for the last year and we end up, and we are now cleaning it. That's if you look at this time, we are clearly even now. We have done it. We invested in our employees again. To your point also, if the employee cost has gone up in Q2, yes, it has gone up because we had pay hikes. We had investments. We have done this. We could have decided saying that, company's not making gains. We'll not pay anybody the variable pay or the performance bonus. But in a human capital, people-centric business, it's an investment we have to make. It's very, very clear, and I'm very blunt about that as well, as you rightly said, a blunt question. Without this human capital investment, I don't think this company can have the scale or the ability to turn around. Let's be very clear about it. I don't have to mince words at all. Second, important point is now how do you drive efficiency from this investment? That is what we are now trying to say. Now we are saying fair enough, we have invested, now we have to right-size the organization, right cost the organization, and right-size the organization. If I can use the 3 R's if I look at it, that is very, very clear. We want to be ruthlessly focused in H2 now. Now that we have invested in our talent, our critical resources, we have done that. Now we are expecting every rank and file to rally with us to make it happen. And they're very, very clear and clinical about it. So that's in my take on some of the questions which you asked, Mr. Purushottam. It's a very, very good question. And we will see, and second thing also, to your point, some of the investments we are making is also a little ahead of the curve. Say, for example, you will start seeing the results of that in Q3, Q4, because for a company like us, we have taken some proactive calls. Let's say, for example, we invested in 100 engineers in Oracle certification. That's a cost which is hitting us in Q2. But monetizing it will happen in Q3 and Q4. So right now, as you read, it might be there. But now, this time, these 100 engineers who graduate are going to be billable, and they are going to increase our gross margins because it's a tier 3 city. The difference of salaries between these kids in Tirunelveli to Mumbai is almost 100% costlier in Mumbai. So that all these results will have coming to effect. Both of and Sanjay and Harish, you can add if I missed something.
Just to add, Shilpan, I think in terms of capability building that we have done, I think I mentioned one example, but that's what we have done across the organization. So though we had infrastructure management services as a unit, today we are in banking grade infrastructure management services. Earlier it was not. Now, when we want to get this capability in our organization, the lower level resources can be recruited on a project base. But the mid and the senior management to drive these initiatives and the capabilities will have to be invested on. And when we invest on these resources, the break-even comes when we reach a critical mass, and for that, the sales engine has to run it. So it has started now, but when we can say that we can break even is when we have more business in that particular line of business for the capability that we have built. So these are the costs I have. To be candid, I think we have done a thorough analysis as to why it is hurting us on the margins. I think even Siddharth mentioned that in his question there, and wanted to clarify. Now, since you also raised it around that, we wanted to be specific about it. So I think we are looking at H2 that the capabilities that will have built in will be fully utilized. Today they are underutilized.
Exactly.
And that's the reason the margins are a little tighter. And when it gets fully utilized, I think we'll see better margins in H2. That's the plan that we are working towards. And as mentioned, we are wherever we feel that it might not fire, it might not work out for us, we are trying to rationalize costs wherever applicable. Thank you.
Okay. Now I have a related question. See, we have time and again heard from you saying that the FY30 will become a $1 billion organization. Now we are left with 7 years from now. So since no growth has come from last year to this year, and previous year also growth didn't come. So what we are doing is we are leaving too much of growth expectation for the fag end of the over. So are we saying that within 7 years we will grow 10 times from now? Are we confident? Because that's a huge ask, 10 times.
No, Purushottam, it's a great question, and thanks for reminding me of the team on the goal we set for ourselves. $20-30 billion is a clear-cut goal we set for ourselves, and we're rallying our organization in that direction. Just to clarify, I'll set even the day one I told you, 6 quarters ago, I think the first quarter when we spoke as well, is very clearly our midterm goal, 3 years goal we set for ourselves was 1,000 crores, 100 crores. I'm just reminding everybody, that's what we set for ourselves. We started with the 608 crores is what we inherited. Last year we reached 674. This year we have targeted 760 crores. Okay. The third year, the biggest jump will be, so 760 to 1,000 is the big jump, right? Which I agree with you, because when we took over, obviously, 2 quarters we got lost because of a lot of legacy issues, settling down, stabilizing over a car now. So if you look at it in my head and my team's head, we are looking at 3.5 years, we need to hit the run rate of 1,000 crores, 100 crores, very, very clearly. That's our first milestone as an organization. Second, it's a classic question which people ask us basically because on a normal IT services company with a, year-on-year, a CAG of say 20% or 25%, you will never hit $1 billion. Just to clarify also, some of the product strategies we are investing today, and as I said, my Neure Edge product is now commercial grade. So that's a product. I'll give you a small example. These are not standard B2B services. These are envisioned to become a B2B2 services, which are absolute force multipliers. As we are talking to you, we have pilots running with telcos, where our product will be white label, which will be offered to telcos, SMB and enterprise segment for SASE. So just look at the scale which this will happen. The second scale is it is B2B2C. So if you look at it for us, a very simple billion-dollar dream would be that 50 to 60% will come with this classic services business model. The balance 20% will come with a as a service model. Anything could be as a service or whatever it is, B2B, and the last is definitely the B2B2C is where we are hoping, where we will differentiate ourselves. And this is going to be the scale which we are working. These are all parallel tracks we are working. It takes time. With our balance sheet and our, frugal reserves, what we have, it is a very, very tough ask to kind of, manage all these tracks. To your point, but these are all in track. These are all in track. And once these start scaling, this will start multiplying in a different level, Pushop.
Okay. Thanks for clarifying. Just on a lighter note, we may be expecting too many Virat Kohlis in our team to hit in the slog overs. So hope it happens.
No, absolutely, Pushop. We have brought in all the Virat Kohlis. I didn't bring all the Kohlis for this call. Maybe next call, once they have some stripes on their back, I'll get all the Kohlis there. The Kohlis are all there.
Great. Thank you. Thanks. Bye.
Thank you. The next question is from the line of Sanjay, an individual investor. Please go ahead.
Thank you for the opportunity. Mr. Thompson, just during your first talk, you mentioned about some new logos. I think 50 new logos in Q2, and even some large deal you mentioned. I didn't get that exactly. So can you just elaborate on out of how many large deals, which is like more than 5 crore value, have been won in Q2? And in which areas? And is it more on application side or cloud side, IMS side? Second question is about, are you seeing any traction again? You have made investment into what is like as in that US-based company as well as Malaysia's oil and cloud that has been launched. So when you start getting revenue from those initiatives which we have invested so far on that?
Yeah. Thanks, Sanjay. Thanks for asking my favorite question. I love to answer this. Thanks a lot. The first question is, on the logos, as I said, it's almost H1, we are close to almost 29, 30 new logos we have got. Because that's an important milestone for us as we are fighting back into the ranks. If you ask me, these are all very, very valuable MSAs. Though the contracts might be small, right now it might be 1 crore or 2 crores or, half a crore contracts which we have gotten. But it's important that we have these MSAs with 30 new customers. That's the positive side of it. And we are now trying to see, can we have 100 crore account plan for these logos which is there. The second question which you asked me is like, if you look at large deals, I won't call it very big deals, but significant deals, if you look at it, like what Harish spoke about. Now we are expanding in the GCC space. For example, the digital infrastructure management space is something which we see huge traction, and we are winning a lot of deals in that space, especially where we are winning against the existing incumbent tier one. So that's a very clear, opportunity for us as a nimble, faster tier 2 organization, and a lot of customers are ready to experiment and give opportunity to people like us, and we are starting to win that. We see huge traction in the DIMS, digital infrastructure management, in the GCC space. And in fact, our win in Dhanalakshmi Bank is a fantastic win for us because we fought against all the big boys there and we won it. And it's a very memorable win for us, So that has given a real shot in the arm. Second, I also see a huge traction even in the cybersecurity operations space as well. Some of our investments, I'll touch upon. You asked me another question on the US investment which you made on the XDM as a core technology, because see, today we are building a lot of our IP around that core technology. 3 or 4 things which we have progressed on that technology. One is our Nure Edge product, which is a sachet product. It's built around it, which is now commercial grade. We have paying customers. Second, as I said, the B2B2B I'm talking about also is on the telco strategy, where we are going to telcos to take our sachet product to their customers, which is happening right now. So that will also, you can equate it to monetizing that investment we made last year, which you rightly pointed out. Second, what we are also doing is also we are building using our 5G lab as a service. Our platform and product is being built. We want to offer it as a service on the 5G core of XCM platform. So that's one of the investments. So that's a part of the strategy, and we are building this 5G lab as a service. And in fact, it is right now in works in our IIT Tech Park, and we will launch it commercially in some of the other Western markets to test it. And we are talking to some telcos. We are talking to some even private large manufacturing houses to see how we can use our 5G lab as a service for their own Industry 4.0 and all that good stuff. That is one. The third thing is also private network and SD-WAN as a service. These are phenomenal stuff which you are building on this core investments which we made in US technology country. I don't know whether I answered your question. And also you spoke about the Nure sovereign cloud, correct?
That's correct. Yeah. How's it that going? I mean, are you seeing now revenue coming up from that Malaysia initiative?
Yeah. See, the investment we have made in that is, as you said, we have to proactively invest in the sovereign cloud because this is a fundamental. And around that, we are now built our Nure Velocity and other services around it, and also our sachet products and various stuff. And now we are getting into the channel route there because we have to keep our costs low as well. So we are now appointing channels. Now the beta runs are run. It's all commercial grade. Because see, we want to offer it as a service. We can't offer this like a typical enterprise services where you keep running around between multiple customers. We are in the last leg where we are getting our billing systems all integrated, getting our channels ready. And then, it will be like a run rate business, Sanjay. That's the way we look at that. Sure. Apart from that, we are also looking at some large customers, banks and other customers where we are selling our service as a disaster recovery as a service, for example. We are in very mature conversations with some local banks and everybody in the local Malaysian territory where we can at least sell this as a DR service, and that probably, maybe I'm happy to report in the Q3 possibly, Sanjay.
Sure. Thank you, Thompson. Just one more question about the business. Looks like there is some downtick in US, UK, and MEA business compared to last Q2. Is it kind of it's a situational thing? Is it like, are you seeing the more demand and business will be coming up from these regions, or it will be in the same range, or it will be going down?
See, for us, Sanjay, there are two parts. See, one is what we are also doing is we are also cleaning up our books also. See, what is happening proactively, we are knocking off accounts which are non-focus accounts or strain on us, like low margin accounts, which are red accounts, which are cleaning up, okay? Because the impact of them on our bottom line is high, so we have done proactive cleanups in US, Middle East, everywhere we have done a cleanup. That is one. Second thing is, obviously we had some correction happening in Q1, Q2 in our onshore numbers because of obviously the green card issues. Once we had a lot of green cards happening, it impacts us. But we are now back on track because we are now back on track on that. So we had a temporary impact on that. That will get nullified in Q3, Q4. We'll be back on the run rate on the traditional attritions which happened because of green card, issues. But your question, we are very bullish about US and UK. In fact, I'm parking myself in US for the next 1 month because the good thing which is happening for us, I'll tell you, is with these heavy headwinds in these economies like US and UK, there's a big opportunity for a more faster, agile challenger like us. And we are getting a lot of traction there and in our existing accounts, a lot of new accounts as well. We are very positive about the entire, region in US and UK, Sanjay, because there are a lot of opportunities coming up. A lot of companies are into, huge cost optimization. And, most of the non-core or enabling businesses, technology, they are ready to experiment. And one of the good things we did is we invested in cloud. First, if you look at it, we have been very consistent. That is starting to pay because cloud is going to be a recession-proof industry, right? Second, we are also now trying to take the entire edge-first, edge-ready technologies we have built, this 5G lab, all these good stuff, what we have built, and now we want to focus on agri-tech actually. So agri-tech also will be, and agriculture will be a recession-proof industry, Sanjay. So we want to just stay focused on some of these 2-3 tracks, build on our BFSI credit union pedigree, which is there, like mid-sector banks, focus on, agri-tech with edge-tech and things like that. And, just stay focused on some and also work with the telcos sell through them, Sanjay.
Sure. Thank you, Thompson. Thank you for the information.
Thank you.
Thank you. The next question is from the line of Atmaram, an individual investor. Please go ahead.
Good afternoon, Thompson. I am an investor for more than 10 years with 3i, with a huge investment. I've been listening to you for now many quarters. Every time I listen to you, things look very, very bright. But even revenue stuck at 177 crores quarter after quarter. Out of 177 crores, 146 crores is employee cost. How long will we keep on hearing positive things without numbers actually reflecting? Because you talk of so many Fortune 500 clients, you talk of so many clients, you talk of so many employees, yet quarter after quarter the story in numbers doesn't change. This is something that really perplexes me. How at least when will we reach at least a 200 crore revenue? Which quarter will be even reach a 200 crore revenue? And if you are cleaning up things, why is employee benefit costs keeping on increasing? Are you not removing people then? This is something that I'm not able to understand. Numbers don't really match with what you talk about.
Yeah. So, Mr. Atmaram, I think, even some of the other investors did raise the same question. I did try answering the part of it, but I'll try and keep it very simple, because I'm not going to again talk about what I spoke earlier in the call, very similar. I think we are very focused on, now the focus will be to right-size the organization, because there are 2-3 parts. The way I look at it is, the services business we inherited post the carve-out is like a company A in my mind. That company A has to be made profitable on its own. The company B is all that other stuff what we are now investing and building, which has to also, it's like a startup, which has to be on its own. So these are 2 separate tracks which we want to kind of track and make it happen. As I agree with you, because we have also made some people investments in advance. If you ask me, we have also been very, very, in terms of giving a slightly longer runway for whatever it is. But I think right now, if you ask me, we are into that very clear mode of right costing and right sizing. And that will be our focus area, because that is going to be very, very important for us. Because I think we are very clear in terms of our growth areas. We are very clear in terms of how we want to build our funnel or order book way forward. But I think I agree with you very, very clearly. We have to take now a very clear clinical action on our cost optimization and right-size the company, which you will start seeing the results in the coming quarters, where we want to immediately start right-sizing it. Because it's very important also for us also to be, right-sized and maybe at the right health to face this new changing environment across our world actually. And a company like us also, with the product division gone and we are rebuilding everything from start, from services. And just to remind you, since you've been with us for 10 years, 3i has been a product-led company, which also had services. So we were never a services company. So now what we are attempting to do is that to build a true blue services company on parity with any of the other peers. So that's the first step. I think, we need the support of, investors such as yourself who have been with us for so long. It's very, very important to first recognize that. Because any other services company has a huge offshore presence. Because the arbitrage, the labor arbitrage has huge margin. You have huge opportunity to play. But whereas we have only onshore numbers, our offshore mix is very, very less compared to any other services company, and which we are now striving to see how we can work within the constraints and change. But I can assure you that, these changes will happen.
Actually, if I can ask, just expand on that question. 5,500 employees. I would request that it's high time we don't talk about legacy. We know the problems of the legacy. We were hopeful after you came in. So let's, because quarter after quarter talking about the past product company, service company, all that is fine. Do you really need 5,500 employees? When you have 400 clients, 80 Fortune 500 companies as your clients, when are we going to see the numbers of the top line growing and your number of employees coming down drastically? Because if you are no longer going to do all, or it's not worth doing all the past low margin business that 3i was doing, why do you still have 5,500 employees?
No. I'll take this question. See, very, very simple, okay? We are all in the same plane. We are all flying in this. All these 5,500 employees are billable people, not one human being. If you look at it, if you dissect it also, the problem is if you look at it, if you break it down, there are 2,500 people employees who are there. If you break it down and if you have the breakup of the employees, this is available in our chart. Now the problem is, as we optimize on one side, we have to grow the other revenue mix change in the other side. It can't be binary. Now, if I say that I'm going to reduce this 5,500 people, it will have a direct impact on your top line because the contract mix is not changed. Engagement mix with the customers are not changed. The revenue mix has to change. New customers we are bringing them with a different contract engagement model. We are bringing with truly digital models, new customers. Old customers are on a cost plus model, or it could be a time and material model, or it could be any other model. So it takes time to change the mix of contracts. It cannot change overnight. It is not so simple. That's what I'm saying. See, for example, if you take any peer services company, he will have 80% of his employees working offshore for a US customer and 20% works onshore. He has huge margin on that. But if you look at our model today, people are all domestic predominantly. Every guy works in that country, gets invoiced in that country and does that. So the offshore mix is very less for us today. So you don't have that advantage. The second thing in the modern world today, 2022, offshore is also now old school now. Now customers are saying, bring me back jobs to America. You did with 100 people in India. Can you do it with 50 people in America with digital and cognitive and all that what we are preaching? And that's what now the game is. The game is now, can I get my jobs back from Chennai, Bangalore into New Jersey? That's what customers are talking about. Those are the new age contracts today actually. So that is an opportunity for 3i now to see that, okay, can I work on that strategy right now? So now that is what we are bringing this geo-focused strategy, moving away from a very India-centric strategy into a geo-focused strategy. That's what even Sanjay expanded about, our new organization structure and how we are doing it. Now there can we make more profitable businesses onshore is what it is. The new contracts we bring will not need so many people as you rightly said. For what a traditional guy does with 100 people, we can do 50 people and still make more margin. But these are new contracts. Existing contracts, customers are currently, we are working with them to try and change it, but it takes time. Now, if you ask me the question, reduce 5,500 people to 3,000 people, it will have a direct impact on top line. We can go ahead. We are doing it in our own small way wherever there are non-profitable accounts. We are closing it down. If you look at it also, we closed down an account in Middle East in Q2, which had an impact, but we went there and took it because it's a bleeding account. Just for top line sake, we didn't want to keep it. We closed it, and it will have a positive impact for us. So we have to be mindful of this. We need to manage this in parallel and ensure that these two lines will converge.
And just to add one point here, when we are saying that we will not reduce employees, we are consciously have reduced employees. If you look at the employee cost, instead of giving an 8% overall increment across the board or average increment across the board, we are still cost flat on the employees. On the direct cost. So that actually converts into 8% of people cost being reduced or people being reduced.
Yeah.
So I think, it would be a little unfair to say that the costs have not been going down. There has been conscious efforts on that and it's going to continue. So I think H2, by end of H2, as I mentioned in what I spoke, we should be seeing much more leaner and leaner organizations as it is.
And also the contract mix has to change, because the contract mix we are tied, because that is what we are striving today. So we are working with customers to change the contract mix so that it gives us the flexibility we can do it with lesser number of people. But the good thing I'm seeing is recession is going to help us now. Now customers who didn't listen to us will listen to us, and we'll be able to now negotiate better contract mix with them.
Okay. Okay, thank you.
Thank you. As there are no further questions, I now hand the conference over to the management for their closing comments. Over to you.
Hey, thank you. I think, we could have taken more questions. It's been always fantastic taking questions and clarifying our questions, which our shareholders asked us. So it is always a pleasure to talk to our investors and shareholders, because it is always it gives us a good insight. And I also want to really thank all of you for the support you have given us and the patience you have been with us. And the team, your management team is focused on turning around this company, and we will work. We'll take all the inputs which we got even this call, and we will periodically keep updating all of you, and we will ensure that we will deliver a better H2. Thank you, everybody.
Thank you. Ladies and gentlemen, on behalf of 3i Infotech Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.